Most people believe retirement is a financial finish line. You work for 30 or 40 years, save consistently, stop working, and then live off what you've accumulated. On paper, this sounds logical. In practice, this assumption creates one of the most damaging financial traps in modern personal finance. The core problem is not insufficient saving or poor investment choices. The core problem is the decision to fully stop working. While life expectancy, living costs, and financial complexity continue to increase, many people think they're doing everything right, maxing out retirement accounts, following standard allocation models, and planning a fixed withdrawal rate, yet still end up financially constrained, stressed, or forced back into work later in life. Let's define the real issue clearly. Retirement planning in the U.S. is built around the idea that income should drop to zero at a specific age, typically between 62 and 67, and that accumulated assets should replace that income for 20 to 30 years. This assumption worked better when life expectancy was lower, healthcare costs were smaller relative to income, and market volatility had less impact on long-term withdrawals. Those conditions no longer exist. Consider the numbers. The average American retires with roughly $200,000 to $300,000 in retirement savings. Even among higher income households, balances often fall short of what financial models assume. Using a commonly cited 4% withdrawal rule, a $300,000 portfolio generates $12,000 per year before taxes. Social Security may add $18,000 to $24,000 annually for an average retiree. Combined, that produces roughly $30,000 to $36,000 per year. For many households, this is significantly below their pre-retirement spending level. At the same time, expenses do not decline in a clean or predictable way. Housing costs may remain fixed or increase due to property taxes and maintenance. Healthcare expenses typically rise with age. Inflation, even at moderate levels of 2 to 3%, compounds aggressively over 20 years. A lifestyle that costs $50,000 per year today will require more than $80,000 in nominal terms after 2 decades of modest inflation. Most people assume markets will fill the gap. They expect long-term average returns to smooth out volatility. The problem is sequence risk. When withdrawals begin, market downturns early in retirement can permanently reduce portfolio sustainability. A 20% decline in the first 5 years of retirement, combined with ongoing withdrawals, can shorten the life of a portfolio by a decade or more. This is not a theoretical risk. It is a structural one. There is also a less discussed but equally important factor: human capital. When people fully retire, they eliminate their ability to generate earned income. Skills degrade, professional networks weaken, and re-entry into the workforce becomes harder each year. This removes flexibility from the financial system they depend on. Any unexpected expense, medical costs, family support, market underperformance must be absorbed entirely by assets. From a financial systems perspective, this is fragile. You have a single engine, your portfolio, supporting decades of consumption under uncertainty. The system assumes stable markets, predictable expenses, and no major disruptions. Real life rarely follows that script. At this stage, it's important to be clear. The problem is not that retirement savings are useless or that people should never stop working. The problem is that the traditional retirement model treats work as a binary switch rather than a variable. That design flaw has measurable financial consequences, and over time it affects not only wealth sustainability, but decision quality and psychological resilience. Before discussing solutions, it's necessary to fully understand why this model persists and why standard advice continues to reinforce it, even when the math increasingly works against the average retiree. To understand why the retirement trap is so persistent, it's necessary to examine how income, behavior, and financial systems interact over time. The issue does not arise from a single bad decision. It develops gradually, reinforced by incentives, habits, and standardized advice that prioritizes simplicity over resilience. The first structural issue is income design. During working years, most people rely on a single primary income stream: wages or salary. Retirement planning replaces that income with a combination of portfolio withdrawals and Social Security. What disappears in this transition is earned income that can adapt to changing conditions. Portfolio income is passive and fixed by market performance. Social Security is indexed, but only partially, and it was never designed to fully replace middle-class earnings. When earned income goes to zero, the financial system loses its ability to self-correct. Behavior plays a central role. People are encouraged to view retirement as a reward for discipline. The narrative is linear: work hard, save diligently, then stop. This framing discourages gradual transitions. Once someone identifies as retired, there is often psychological resistance to earning income again, even if doing so would materially improve long-term outcomes. This resistance is not irrational. It is a response to decades of messaging that equates retirement with success and working later in life with failure. The absence of a system is the third factor. Most retirement plans focus on accumulation, not operation. People spend 30 or 40 years optimizing contributions, asset allocation, and tax deferral. Very little time is spent designing how money will actually flow once work stops. Questions like, how does income adjust after a market drawdown? Or, what happens if expenses rise faster than expected? Are often addressed only with generic rules of thumb. Consider a simple scenario. A couple retires at 65 with $1 million invested in a balanced portfolio and plans to withdraw 4% annually, or $40,000 adjusted for inflation. Social Security adds $35,000, bringing total income to $75,000. This seems reasonable. 5 years into retirement, a market downturn reduces the portfolio by 25%. The balance drops to $750,000, but withdrawals continue. To maintain lifestyle, they still withdraw around $40,000. The effective withdrawal rate rises above 5%. The portfolio now has less capital and a higher burden. Even if markets recover later, the lost capital cannot compound in the same way. Now contrast this with a second scenario. The same couple reduces withdrawals by generating $15,000 to $20,000 per year in part-time or project-based income during the first decade of retirement. This income does not need to match their previous salary. It only needs to reduce pressure on the portfolio. That small adjustment significantly improves sustainability. Yet standard advice rarely emphasizes this option. Why do traditional recommendations fail to address this? Because they are optimized for predictability and scale. Financial institutions and advisors rely on standardized models, safe withdrawal rates, target date funds, and age-based allocation shifts. These tools are useful, but they assume a passive retiree. They do not incorporate flexible income, adaptive spending, or human capital as an asset. Another issue is behavioral comfort. Fixed rules are easier to follow than dynamic systems. A retiree can understand withdraw 4% per year. It is much harder to manage variable income, fluctuating work hours, or periodic skill updates. However, ease of understanding does not equal financial robustness. The deeper problem is not that retirement math is wrong. It's that retirement planning often ignores optionality. By eliminating earned income completely, people reduce their ability to respond to uncertainty. Over long time horizons, this rigidity compounds risk. Understanding this is essential before discussing how to redesign retirement in a way that prioritizes durability over tradition. The retirement trap is driven by a small set of recurring decisions. These decisions are rarely framed as mistakes at the time they are made because they align with conventional planning advice. The problem is not intent or discipline. The problem is structure. The first major mistake is treating retirement as a permanent stop rather than a phase transition. When income drops abruptly to zero, the financial system becomes entirely dependent on assets. This creates immediate exposure to market timing risk. If a retiree stops working at 65 and experiences a market decline within the first 5 years, the damage is disproportionately large. For example, a $900,000 portfolio that declines by 20% falls to $720,000. If the retiree continues withdrawing $36,000 per year, the effective withdrawal rate jumps from 4% to 5%. Over 10 years, this can reduce the sustainable lifespan of the portfolio by more than 30%, depending on market recovery. The second mistake is relying on fixed withdrawal rules without adjustment. Rules like the 4% guideline assume long-term average returns and do not account for individual behavior or changing expenses. In reality, retirees face uneven costs. Healthcare spending often accelerates in the later years, while inflation compounds steadily. A retiree withdrawing $50,000 per year at age 65 may need closer to $75,000 by age 80 to maintain the same purchasing power. If withdrawals are not adjusted downward during weaker market periods, portfolio stress increases precisely when recovery capacity is lowest. The third mistake is underestimating the value of human capital after midlife. Many people assume their earning ability ends when their career ends. This is a decision, not a financial law. Skills, experience, and professional networks remain productive assets well into later decades, especially in advisory, technical, or part-time roles. By choosing not to use these assets, retirees voluntarily discard a stabilizing income source that could offset market volatility and reduce drawdowns. Consider two individuals with identical finances at retirement. Both retire at 65 with $1 million and plan for a 30-year horizon. Person A stops working entirely. Person B earns an average of $20,000 per year for the first 10 years through consulting or flexible work. Person B reduces portfolio withdrawals by the same amount. Assuming a modest 5% real return, Person B's portfolio at age 75 can be over $300,000 larger than Person A's, simply because less capital was withdrawn early. That difference compounds further over the next decade. The fourth mistake is assuming higher income earlier in life solves the problem. Many high earners fall into the same trap because they scale lifestyle alongside income. A household earning $200,000 per year that saves aggressively but plans to fully retire at 60 may still face the same structural risk as a middle-income household. If expenses remain high and income drops to zero, the system is fragile regardless of how large the starting portfolio is. Over 20 years, these mistakes converge. Portfolios shrink faster than expected. Flexibility disappears. Retirees are forced into reactive decisions, cutting spending sharply, returning to work under pressure, or taking on more investment risk late in life. None of these outcomes are efficient. The key insight is that the problem is not insufficient income or poor market returns. It is the decision to eliminate earned income entirely and replace it with a rigid withdrawal system. That decision increases dependency on variables outside the retiree's control. Over long time horizons, this dependency compounds risk. Understanding these consequences is necessary before evaluating solutions that prioritize resilience instead of finality. The solution to the retirement trap is not to reject retirement or to work indefinitely. It is to replace the traditional full-stop model with a structured, flexible income system that reduces risk during the most fragile years of retirement. The goal is not higher returns, but greater stability. The core solution is partial income continuation during the early phase of retirement, typically the first 5 to 10 years. This means intentionally maintaining a modest level of earned income instead of dropping to zero at a fixed age. In practical terms, this usually ranges from $15,000 to $30,000 per year. This income does not need to come from full-time employment. It can come from consulting, advisory work, contract roles, part-time positions, or project-based work that uses existing skills and experience. The financial mechanism is straightforward. Early retirement years carry the highest risk because withdrawals begin while market outcomes are uncertain. Losses early in retirement cause more damage than losses later because capital has less time to recover. By supplementing income with even a small amount of earned cash flow, portfolio withdrawals can be reduced or delayed. Lower withdrawals preserve capital, and preserved capital continues to compound. For example, assume a retiree has $1 million invested and plans to withdraw 4%, or $40,000 per year. If that retiree earns $20,000 per year through part-time work and reduces withdrawals to $20,000, the withdrawal rate drops from 4% to 2%. In a weak or flat market, this significantly reduces stress on the portfolio. In a strong market, more capital remains invested, increasing long-term sustainability. Over a 10-year period, this difference can easily result in several $100,000 in additional portfolio value, without requiring higher risk or better market timing. This system also improves income diversification. Instead of relying entirely on a portfolio and Social Security, income comes from three sources: earned income, investment withdrawals, and government benefits. Diversifying income reduces dependence on any single factor. If markets underperform, earned income absorbs part of the impact. If earned income declines later due to age or health, portfolio withdrawals can increase at a point when the portfolio is stronger than it would have been under a full-stop retirement model. The approach does not depend on aggressive return assumptions. It does not require leverage, complex strategies, or speculative investments. It works by reducing exposure during unfavorable conditions rather than trying to compensate with higher returns. This is why it is structurally stable. Most retirement failures are driven by excessive withdrawals early on, not by poor long-term market performance. The system is designed to adapt over time. Earned income can taper naturally as priorities change. Portfolio withdrawals can increase gradually once the highest risk years have passed. This transition is planned in advance rather than forced by market stress or unexpected expenses. There's also a practical benefit for expense management. Unexpected costs, particularly healthcare expenses, are easier to absorb when earned income still exists. This reduces the likelihood of selling assets during market downturns, which permanently weakens long-term outcomes. This is not about working longer for its own sake. It is about maintaining flexibility in the financial system. A retirement plan that includes controlled optional income is more resilient than one that relies entirely on asset depletion. Over long-time horizons, resilience is what preserves wealth. The retirement trap exists because most plans are designed around a single assumption: income stops at a fixed age and assets take over completely. The alternative is not complex. It is a system built on three coordinated elements: controlled spending, partial earned income, and disciplined portfolio withdrawals. When these elements work together, retirement becomes a stable financial phase rather than a fragile drawdown period. The system starts with income structure. Instead of moving from full income to zero, earned income is intentionally reduced, but not eliminated. In the first year of retirement, this may mean covering 20 to 40% of annual expenses through part-time or project-based work. Portfolio withdrawals fill the remaining gap. Social Security functions as a baseline, not a replacement for work. This structure lowers early withdrawal pressure when portfolios are most vulnerable to market conditions. Within the first year, the difference is measurable. Lower withdrawals preserve capital and reduce sensitivity to short-term market declines. Decision-making improves because cash flow is not fully dependent on asset sales. The retiree has flexibility to adjust spending or income without disrupting the entire plan. Over a 5-year horizon, the compounding effect becomes clear. A portfolio that avoided heavy early withdrawals is larger than it would have been under a traditional full-stop retirement. Even modest earned income during this period can preserve hundreds of thousands of dollars in capital. This capital is not just a number on a statement, it represents time. More capital extends the duration the portfolio can support spending without stress. By year 10, the system shifts naturally. Earned income may decline or stop entirely. At this point, portfolio withdrawals increase, but they do so from a stronger base. The portfolio is better positioned to handle inflation, healthcare costs, and market volatility. The retiree is no longer managing risk at the most dangerous point of the timeline. The system has already absorbed that risk earlier. The practical steps to implement this are straightforward and can begin immediately. First, redefine retirement as a phased process, not a date. Identify which skills, experience, or professional relationships can realistically generate $15,000 to $30,000 per year, with limited time commitment. Second, model retirement cash flow with variable income instead of a single withdrawal rate. Test scenarios where earned income declines gradually over 5 to 10 years. Third, plan withdrawals conservatively in early years and allow flexibility later. This reverses the risk profile of most retirement plans. For those still working, preparation matters. Maintaining skills, professional relevance, and optional income streams before retirement is significantly easier than trying to rebuild them after several inactive years. This is a structural advantage, not a motivational one. The financial mistake most people make is not failing to save enough. It is designing a retirement system that removes flexibility at the moment flexibility is most valuable. The solution is not to chase higher returns or delay retirement indefinitely. It is to treat work as an adjustable variable and income as a system rather than a switch. A retirement plan built this way is not optimized for simplicity. It is optimized for durability. Over long time horizons, durability is what allows wealth to last and decisions to remain controlled.